What's going on, guys? Today we're going to be going over the top 4 growth-based ETFs that I personally invest in and love. Make sure to watch this whole video so you get my full analysis on each ETF, the pros, cons, and a variety of different metrics involved with them. By the end of this video, you should have a comprehensive understanding of what each of these ETFs does and what they're composed of and how they work. Now, if you've never heard of an ETF, or maybe you're new to the stock market, you're probably wondering, what is it and how do I use it? Well, an ETF is also known as an exchange traded fund. These are funds that are put together by hedge fund managers or large asset management corporations that typically take large chunks of stocks or capital and put them into stocks and then put them into a portfolio that ideally is rigged to return a lot of growth to the investors in that fund. Pretty much all ETFs have what are known as expense ratios, and this is what it costs basically to hold the ETF. The lower the expense ratio, the better, because that means that that is more money in your pocket, of course, at the end of the day. ETFs can also be known as index funds, and that's just an important detail that I think you guys might want to know in case you ever hear somebody talking about it and wondering if there's a difference between ETFs and index funds. There isn't, of course, it's just another name for them. But getting that quick little recap out of the way, let's get right into my top 4 growth ETFs. So to start, we're going to go with our first ETF on the list here, and that is, of course, Invesco's QQQ fund. Now, Invesco QQQ is an exchange traded fund that tracks the NASDAQ 100 index. This index includes the 100 largest non-financial companies listed on the NASDAQ based on market cap. As you can see here, it's rated number 1 as far as the best performing large cap growth fund, 1 out of 440, which is currently what it's ranked as. We also see that QQQ gives us access to over 100 non-financial companies in a single investment. This is also the second most traded ETF in the US based on average daily volume. If we actually look at the overall historical performance of this ETF, we can see that it's actually ranked the top 1% of large cap growth funds. The fund has been extremely successful in tracking the NASDAQ overall, and it's actually outperformed the S&P 500 almost every single year for the past 20 to 30 years. In my mind, this is overall a very safe ETF to be in, and it's one that I have a decent amount of money in myself. This is also a really great way to expose yourself to a variety of information tech-based companies, and again, the NASDAQ does a very good job of exposing you to these as well. My second growth ETF I'm going to be talking about today is the Vanguard Growth Index ETF. Now, this ETF overall tracks the performance of the CRSP US Large Cap Growth Index. This provides a very convenient way to match the performance of many of the nation's largest growth stocks. We can actually take a look at the overall expense ratio of this ETF, and it's only 0.04%, which is extremely low, and Vanguard has always been very good at providing very competitive rates when it comes to their expense ratios. As far as the overall risk potential goes for this ETF, it is a 4, so it is a little bit on the higher risk side of things. But again, most of these growth ETFs are labeled or what is known, of course, as risky because of the growth stocks that they are holding and tracking. Now, a really interesting metric that I like to look at for some of these ETFs is the hypothetical growth of over $10,000. And as you can see here, if you held from 2011 to 2021, we would see almost up to $49,997 at the end of the quarter that this is tracking. This is absolutely incredible growth, and of course that isn't guaranteed, but again, that is very good over the past decade that it's been tracking. If we actually look at the top 10 holdings of this company, we can see that the 2 or the 3 major holders in this company are, of course, Microsoft, Apple, and Alphabet, otherwise known as Google. If we look at an average of the annualized returns, we can see that the average return on this ETF is just about 11%. If we look at the last 3 years, however, we see about a 25.31% return. Very impressive stuff from an ETF like this, and once again, Vanguard are just top class when it comes to their index funds and the things that they offer with them. Now, the next growth ETF we're going to be talking about today is iShares Core S&P US Growth ETF, otherwise known as ticker symbol IUSG. This growth ETF tracks the investment result of an index composed of large and mid-capitalization US equities that exhibit growth characteristics. Some of the pros of this, of course, include the low cost of exposure to a broad range of US growth stocks whose earnings are expected to grow at an above average rate relative to the market. They actually even have on their website recommended for it to be used as a core position in a long-term growth portfolio. If you look at the overall returns, they're actually really impressive. We can see since its inception, the total return is just about 6%, but what's even more impressive is you look at the last 1, 3, 5, and 10 years, sitting at about 60 to 20, 19, and 15%. Again, these returns are very impressive for what this ETF is made to do, and I really think that it is actually a valuable position in a long-term portfolio as a core position. Now, the expense ratio for this ETF is 0.04%, which if you remember VUG, it has the same exact expense ratio. Again, it's important to have a low expense ratio with these ETFs because that's more money that's going to be going back to you instead of back to the people who of course manage and create the ETF. Overall, I like iShares as a core position in a long-term portfolio, and that's pretty much why I picked it and put it on this list. Now, the very last growth ETF that I want to talk about, and it's a little bit more risky here, is ticker symbol IBUY or iBuy, also known as Amplify Online Retail ETF. So Amplify Online Retail ETF seeks to provide investment results that before fees and expenses correspond generally to the price performance of the EQM Online Retail Index. The index is a globally diverse basket of publicly traded companies that obtain 70% or more of revenue from online or virtual sales. If you're somebody who's big into e-commerce and believes that everything is going to go online in the coming future, this might be the ETF for you. Tracking, of course, online retail, this has produced some incredible returns over the last couple of years. If we look at just last year, this ETF returned over 88% to its holders. And if you look over the last 3 to 5 years, it returned around 36 to 37%. This is absolutely incredible as far as gains go, but again, this is very risky. Due to the fact that this is mostly dealing with only online retail, if something does happen, of course, to online retail, which is highly unlikely to begin with, but if something does happen, there could be a possible pullback in the returns that we're seeing with this ETF. That's why, of course, I'm not heavily invested in this ETF, but I do have some of it for some exposure. Now, overall, I really like ETFs as far as their tax benefits because, of course, with most of these are long-term holds. These aren't assets that I'm planning to sell anytime soon, and of course, I'm only going to be contributing and accumulating more shares and buying into more of a position with these ETFs. This is the great part about ETFs, as they're a lot more tax efficient because usually you're holding them for longer than a year, thus allowing you to take advantage of long-term capital gains, which is typically taxed at a lower rate. ETFs are typically found in retirement portfolios, allowing people to steadily contribute money into these positions without seeing large fluctuations in price or having to worry about the day-to-day operations of the actual ETF itself. They're very passive in nature, and that's why I am a big fan of them. Hopefully this video could bring some insight to you guys and make you guys learn a little bit more about growth ETFs. I think they're a fascinating tool in the stock market. They're a great way to get exposure to growth stocks, especially if you guys don't want to invest in these singular stocks themselves, and two, they're going to be actively managed by an actual fund manager. I hope I earned your thumbs up in this video, guys, and I hope I even earned your subscribe. Please subscribe to our channel. We talk about money, stocks, cryptocurrency, real estate, investing, entrepreneurship, and a variety of other topics having to do, of course, with a dollar sign or money. So if that sounds like that's something that's interesting to you guys, make sure to like the video and make sure to subscribe. Turn on the notification bell too so you never miss a new video like this. If you guys want some free stocks with WeBull, check out our WeBull link down in the description below. When you guys sign up and deposit only $5, you can get some free stocks. And that's a special offer that's only going on till July 20th. So be aware of that. Make sure you subscribe. Make sure you check out the links in the description. But other than that, guys, that is all I have for you guys today. I'm Kyle with Finance Bro. Take it easy.